Hello, it's Bob Steele. In this lecture, we will talk about Chapter 10, Standard Costing and Analysis of Direct Costs. We're going to go to objective number 1, describe the elements of cost control system. So we have the managing costs. We're going to take a look at, we have the standard cost up here, we have the actual cost, we have the cost variance. So the standard cost is going to be kind of like a budgeted cost. The cost that we're going to use, we're going to figure out what the cost we believe should be, and then we are going to obviously go through the process and have the actual cost of what it is after the month has ended or whatever time frame we are talking about. We will then, of course, compare the standard to the actual, and we will come up with a difference, that difference being termed the variance. So we're going to look at the variance, meaning the difference between what we standard cost, what we believe the cost should be, compared to the actual cost. And that is going to be the variance, and we're going to look at significant variances, of course. So when we think about this type of system, what we're going to do is break the processes into parts so that we can then look at individual parts and try to isolate the area that is different, where we have, and the way we do that is we manage by exception. So we're looking for the area that has the biggest difference from our projected cost, and those are the ones that, of course, we will take a look at. So when we see differences, we're going to look for the differences that are outside the norm, the variances that are going to be outside the norm. We're going to manage by exception by looking at those. We're going to leave the others be, and by doing that, our focus is hopefully going to be more efficient in that we will concentrate on the areas that need concentration. Objective number 2, describe 2 ways to set cost standards and distinguish between perfect and practical standards. Okay, so when we set the cost standards, basically what we think should happen, the budgeted costs, we can use the traditional thing that we're going to use whenever we think of any kind of budget or setting some kind of standard or thinking about how we're going to do in the future, is to think about how we did in the past. So how did we do last month? We could take a look at last month and see what we believe the cost standard should be in future months. That's a typical way to set any type of budgeting or projection into the future. Of course, we would like to be more specific if possible and be somewhat task-oriented, which means that we're practically going to look into the future. We're going to ask engineers, well, what did it cost last month? Is it still going to cost that next month? Why or why not? Are there any more practical cost standards that we can implement in order to set our costs in the future that the past data is not taken into account as well as it should? And in doing so, this is a collaborative process when we're trying to come up with these cost standards, because they're really important and they affect a lot of different things. When we come up with these projected cost standards, we want them to be fair in order for us to be able to measure how we're doing in the future. So, of course, the accountants will be involved. Engineers, we're gonna be dealing with, if we make stuff, we're dealing with what types of material should we buy? Should we buy cheaper material, more expensive material? How much man hours will it take to do this or that task? So we have personal administrative, product managers, combined efforts to set standards based on experience and expectations. So setting the standards will be a collaborative effort. The accountant, of course, only knows the accounting side, how to manage the data. And of course, we'll have to talk to the engineers in order to know what the best process is to be, how long it will take, what kind of materials we will want to be using. So perfect versus practical standards, a behavioral issue. So should we use practical standards or perfect standards? So perfect standards are what they are. They're perfect. Nothing is perfect. People aren't perfect. It isn't a perfect world. Therefore, perfect standards by definition are unachievable. So you can imagine basically someone saying, how long does it take to make a widget? And you can imagine them clocking someone, and it takes exactly 2.30 seconds, a minute, 2.30 minutes to make a widget. And therefore, to make 10 widgets, we're going to multiply that out times 10, and that's how much time it should take. Well, that's a perfect standard, because in real life, people get tired, and people go have bathroom breaks and have lunch and stuff. So there are things that perfect standards do not take into account. Now, a lot of people like perfect standards because they are kind of that pie in the sky area. They're that unachievable goal, and therefore it's something that by definition can't be achieved, because it would be the perfect achievement to do so. and therefore it always gives something to shoot for that perfect standard. But more and more people are saying, well, to have something that is never achieved can be disincentivizing. So a lot of individuals would say, let's make a standard that's achievable. So I agree that perfect standards are unattainable and therefore discarding and discouraging employees. So we don't want something that's going to be unachievable. We generally want to set the benchmark where it's difficult but achievable, and so that we can hit those benchmarks. So use standards by service organizations. So note that we're talking about manufacturing organizations because they're kind of the most complex of organizations in many ways, because we have to go through the manufacturing process. Service organizations are going to have many different types of standards as well. Standards in terms of how long does it take to do certain services and what the satisfaction of those services are. So standard cost analysis may be used in any organization with repetitive tasks. So you can think of anytime there's going to be a repetitive task, how long is that repetitive task going to take? How efficient should it be done in the process of that task? And what we're looking for with managerial accounting most of the time is to quantify the data in some way, even if it's not financial data, so that we can then analyze performance and then see if we have achieved certain goals and see if we can set a different benchmark out for achievement. So a relationship between tasks and output measures must be established. And that is it for the first